Financial issues in corporate governance. Institutional investors acting in a fiduciary capacity should disclose their corporate governance and voting policies with respect to their investments, including the procedures that they have in place for deciding on the use of their voting rights. The effectiveness and credibility of the entire corporate governance framework and company oversight depend on institutional investors' willingness and ability to make informed use of their shareholder rights and effectively exercise their ownership functions in companies in which they invest. While this principle does not require institutional investors to vote their shares, it calls for disclosure of how they exercise their ownership rights with due consideration to cost effectiveness. Votes should be cast by custodians or nominees in line with the directions of the beneficial owner of the shares. Custodian institutions holding securities as nominees for customers should not be permitted to cast the votes on those securities unless they have received specific instructions to do so. Holders of depository receipts should be provided with the same ultimate rights and practical opportunities to participate in corporate governance as are accorded to holders of the underlying shares. Institutional investors acting in a fiduciary capacity should disclose how they manage material conflicts of interest that may affect the exercise of key ownership rights regarding their investments. The incentives for intermediary owners to vote their shares and exercise key ownership functions may differ from those of direct owners. Conflict of interest. Example, an agreement to manage the portfolio company's funds. The corporate governance framework should require that proxy advisors, analysts, brokers, rating agencies, and others that provide analysis or advice relevant to decisions by investors disclose and minimize conflicts of interest that might compromise the integrity of their analysis or advice. Insider trading and market manipulation should be prohibited and the applicable rules enforced. As insider trading entails manipulation of the capital markets, it is prohibited by securities regulations, company law, and or criminal law in most countries. These practices can be seen as constituting a breach of good corporate governance as they violate the principle of equitable treatment of shareholders. However, the effectiveness of such prohibition depends on vigorous enforcement action. For companies who are listed in a jurisdiction other than their jurisdiction of incorporation, the applicable corporate governance laws and regulations should be clearly disclosed. In the case of cross-listings, the criteria and procedure for recognizing the listings, requirements of the primary listings should be transparent and documented. Uncertainty among investors. The company should clearly disclose which jurisdiction rules are applicable. Cross-listings. The stock markets should clearly disclose rules and procedures that apply to cross-listings and related exceptions from local corporate governance rules. Stock markets should provide fair and efficient price discovery as a means to help promote effective corporate governance. Effective corporate governance means that shareholders should be able to monitor and assess their corporate investments by comparing market-related information with the company's information about its prospects and performance.